In this video, I'm gonna write a backtest for one of my old trading strategies that I even made some money with years ago, but I never properly tested it. I just trusted it. I had a feeling that of course it should work. It made sense. But was I right? This is something we are going to find out today. The idea was very clear and very safe. I find one pair of coins that behave suspiciously similar. They can have a huge price difference, like 100 times price difference, no one cares. What is important is how the price changes. When one goes up a little bit, another one goes the same. When one goes up strong, another one just does the same. This direction and magnitude are suspiciously alike. And this correlation is worth money. Because when they suddenly stop being the same thing and start differ, the assumption is that this difference is temporary. Maybe it is just one of these companies spent their marketing budget and that's why they pumped. Or another company just lost their main developer and the market doesn't believe they will deliver without him. So my bet was that if the whole previous year these lines were basically the same thing, didn't they ever pay for any marketing? Or did any developer never leave the company before? Usually, recent events don't change everything at once. We have the whole year of high correlation, and here we have just couple weeks. Therefore, my bet is they are going to rebuild their relationship. That's why I sell one that went up and I buy the underperformer. In trading, when they buy, they call it long, and when they sell, they call it short. And when these lines kiss again, this one will give me a profit from my short, and this one will pay me from my long. And in the beginning, I said that this strategy was very safe, because it is completely market neutral, which I considered was good back then. It means that if the whole market goes down while I'm in the trade, yes, I will lose some money from my long position, but it's going to be compensated from the short. So it doesn't matter where these lines cross. As soon as they do, I fixate my profit, which is predictable and always this wide. However, if they don't make up, then I lose. As well as if this price goes up more than 100%, then my loss on the short will be 100%, so the exchange will automatically force close it. It's called liquidation. And then my long will not be market neutral anymore, which was the point of the strategy. So here I run the simulation in cycles to test different parameters, and here are the results. The first thing that we see is the market is very correlated. 0.75 is not rare at all. Even more, pairs that are really correlated have 0.9 and above. But when years ago I found some pairs manually, I thought that I found gems. Now I know, regular stones, worth nothing. Then we see that even if we prefer only highly correlated pairs, our median profit is 0.075, which is just 3.75% because we need $1 for the long and another one for the short. But the numbers are positive, so we can repeat it a million times and become rich, right? The problem is that some of these trades can take months, and they don't even happen often anyway. Which means that while we are in the trade, our money is frozen by the trade, the market is growing without us. So any simple strategy like holding of Bitcoin outperforms us drastically. In a conclusion, this strategy gets 3 stars out of 5. The first one is for being predictable. The second one is for being kind of a winner. It's better than losing your money. And the third one is you don't need any low latency connections, you don't need any supercomputers, you can just trade it manually. To get 5 stars, you should also outperform the market, no matter which direction it's going. But at least this game was fun.